appeal to some consumers, others prefer products that have the potential for higher returns. Variable annuities give contract owners this growth potential. A variable annuity, VA, functions like a fixed annuity, except it does not guarantee principal or interest. Single premium immediate annuities are available, but most VAs are purchased as deferred annuities. While the goal is to realize greater investment growth than would be expected with a fixed annuity, there is no guarantee of this happening. In fact, VA account values may decrease. Variable annuity accumulation. A variable annuity's value moves up and down in response to the investment performance of the sub-accounts chosen by its owner. Like variable life insurance, variable annuity premiums are invested in sub-accounts that have different investment objectives. To keep these non-guaranteed assets separate from the general account assets supporting its guaranteed products, insurers maintain sub-accounts in a separate account. It is not uncommon for separate accounts today to hold 20 or more sub-accounts, ranging from conservative interest-bearing money market and government bond funds to aggressive stock funds. Variable contract owners are generally free to allocate their premiums among any of the sub-accounts offered by the insurer. Likewise, they can reallocate their contract funds among the various sub-accounts, subject to certain conditions. Variable annuity accumulation units. A deferred VA's contract value is measured by the total number of accumulation units in its sub-accounts. Accumulation units are purchased with each premium payment. The number of units acquired depends on the sub-account's net asset value, NAV, on the day the premium is paid. The NAV represents the cost of one accumulation unit. NAVs change daily, based on their underlying assets' investment performance, so the number of accumulation units purchased changes with each premium payment. If the NAV rises, fewer accumulation units are acquired with any given premium amount. If the NAV decreases, more units are acquired. The value of each sub-account in a variable annuity equals the sub-account's NAV on the day of the calculation multiplied by the number of accumulation units in that sub-account. The annuity's total value is equal to the sum of its sub-accounts' values. Example. Jean bought a variable deferred annuity and split her initial $2,000 premium between a U.S. blue-chip stock sub-account and an international growth stock sub-account. At the time of purchase, the accumulation unit value, i.e., the NAV, of the blue-chip sub-account was $10. For the international stock sub-account it was $12. Thus, Jean bought 100 accumulation units of the blue-chip sub-account, i.e., $1,000 divided by $10, and 83.33 units of the international stock sub-account, $1,000 divided by $12. 1 year later, when Jean pays another $2,000 premium, the NAV of the blue-chip stock fund has risen to $10.75, thus, she purchased 93.02 accumulation units and now holds 193.02 units in that sub-account. The NAV of the international stock has dropped to $11.25, thus, she purchased 88.89 accumulation units and now holds 172.22 units in that sub-account. Variable annuity annuitization. Variable annuity contract owners can annuitize their contract under a fixed or variable settlement option. Variable annuitization provides income payments that are not fixed, but instead change in response to the performance of the contract's underlying sub-accounts. Variable annuities offer the same settlement options as fixed annuities. Straight life. Life with period certain. Joint life. Fixed period/fixed amount. The assumed interest rate. A basic factor in any annuity's income payment calculation is the interest rate at which the undistributed funds will grow while income payments are being distributed. With fixed annuities, the guaranteed interest rate is the basis of this calculation. With variable annuities, it is more complicated. Since VA investment returns are not guaranteed and can fluctuate widely, insurers have to estimate the rate of return the fund will earn during the distribution phase. They use an assumed interest rate, AIR, in place of a guaranteed rate. The AIR is the rate of return that the contract's values are assumed to earn over the annuitization period. Insurers usually offer VA contract owners several AIRs to choose from, for example, 3% and 5%. The insurer uses the AIR and settlement option selected by the contract owner to calculate the first month's income payment amount. Annuity units. After calculating the first month's payment amount, the payment amount is converted into annuity units by dividing the initial payment amount by the contract's current net asset value. Once determined, that number remains fixed and becomes the basis for all future income payment amounts. While the number of annuity units is fixed, their value will vary over the annuitization period to reflect sub-account's ever-changing net asset value. Impact of AIR on future annuity payment amounts. Future changes in the annuity payment amount are directly influenced by changes in the sub-account's net asset values and how they compare to the assumed interest rate. If the change in the NAV equals the AIR, there would be no change in the annuity income amount, since the actual rate of return equals the assumed rate. If the NAV rises greater than the AIR, meaning actual investment performance exceeds assumed performance, the annuity income amount will increase. If the NAV decreases, or increases less than the AIR, the annuity income value will decrease. To minimize the chance of a decrease in the monthly annuity income amount, it is important to select a realistic AIR. A higher AIR produces a larger initial payment but requires a higher investment return to maintain the payment amount. A lower AIR produces a lower initial payment but more easily enables the contract to generate the same or higher future payments. Example: a variable annuity contract owner recently annuitized her contract, selecting a 3% AIR. The first monthly payment was $2,000 and the NAV at the time of annuitization was $10. The $2,000 first payment, divided by $10, equates to 200 annuity units. This number stays constant. This contract will forever have 200 annuity units as the basis of future annuity income payments. If the NAV in the second month is $10.02, a 3% annual growth, the income payment will remain $2,000. If the NAV is less than $10.02, there will be a decrease in the income amount. If the NAV is more than $10.02, that is, greater than a 3% annual growth, the income amount will increase. Variable annuity contract charges and fees. To cover the administrative fees associated with a variable annuity, insurers impose several charges and fees that may be deducted from premiums or from the sub-accounts, including mortality and expense, M&E, costs. These cover the cost of the contract's death benefit. Fund management fees. These cover the cost of managing and administering the separate sub-account investment portfolios. Annual contract fee. This charge covers the cost of administering the contract. Variable annuity death benefits. Like fixed deferred annuities, variable deferred annuities provide a death benefit if the owner or annuitant dies before the contract's funds are annuitized. This is the one aspect of variable annuities that is guaranteed. Under most variable annuities, the death benefit equals the greater of the premiums paid into the policy, less any withdrawals, or the contract's accumulated value at the time of death. Variable annuity riders. Variable annuities, VAs, have special riders that add a guaranteed element to their withdrawal options. Common examples include Guaranteed Minimum Accumulation Benefit, GMAB, rider, guarantees that the VA's death benefit, i.e., its accumulated value, will be at least equal to the sum of premiums paid after a specified period of time minus previous withdrawals. Guaranteed Minimum Withdrawal Benefit, GMWB, rider, lets the contract owner withdraw an amount at least equal to the sum of premiums paid. Annual withdrawals are usually limited to a specified percentage, for example, 5 to 10%, of total premiums paid. Guaranteed Minimum Income Benefit, GMIB, rider, provides a guaranteed minimum life income regardless of the contract's accumulated value. At a specified future date, the deferred VA may be converted to an immediate annuity that provides income payments based on the greater of the guaranteed minimum account value or the actual accumulated value. Guaranteed Lifetime Withdrawal Benefit, GLWB, rider, lets the contract owner receive a lifetime income without having to annuitize the contract. Regulation of variable annuities. The Securities Exchange Commission, SEC, is responsible for regulating the securities that make up an insurer's separate account. The Financial Industry Regulatory Authority, FINRA, regulates agents who sell variable insurance products. It also regulates companies that sell investment products, including insurance companies that sell variable contracts. Agent qualifications to sell variable contracts. To be properly registered to sell variable insurance contracts, agents must hold either a FINRA Series 6 or Series 7 registration. They must also hold a valid life insurance license in the states where they do business. Some states also require a state-issued variable agent's license. If your state requires a license, you will find more information about it in the state law units of this course. For your review. Variable annuity, VA. Contract owners assume the investment risk. The growth of a VA's account value during its accumulation period is measured in terms of accumulation units. Its value is equal to the total number of accumulation units multiplied by the NAV at that moment. Insurers use an assumed interest rate, AIR, selected by the annuitant when annuitizing a variable annuity. A higher AIR produces a larger initial payment but requires a higher investment return to maintain the payment amount. A lower AIR produces a lower initial payment but more easily enables the contract to generate the same or higher future payments. Variable annuity riders add a guaranteed element to their withdrawal options. Please pause the audio and watch the video.
Traditional fixed annuities feature guarantees that appeal to some consumers. Many consumers today prefer products that have the potential for higher investment returns. Variable annuities, equity indexed annuities, and market value adjusted annuities give contract owners this growth potential with risks that are described pretty clearly in the lesson. A difficult concept for students to wrap their minds around when we talk about variable annuities is the assumed interest rate, or AIR. So I want to just take a moment to talk a little bit more about this important factor in determining the payout or the payment that comes out of a deferred annuity. Combined with other factors such as the annuitant's age upon annuitization, spousal coverage options, and the type of annuity payment chosen, the AIR determines the monthly payment that the annuitant will receive. The AIR is the rate of return that the contract's values are assumed to earn over the annuitization period. Now, let me explain what that really means. Every annuity, deferred, every fixed annuity, variable annuity, every annuity is based on the assumption that the money sitting with the insurer is going to earn interest while it's being paid out. If it didn't earn interest, the amount of money that could be distributed to the annuitant would be much less. With a fixed annuity, that's not a very complicated prospect because the interest earned is a guaranteed amount. But with a variable annuity, that's not true. With a variable annuity, there is no guaranteed interest, so the insurance company needs to make an assumption of what the money is going to earn while it's sitting in the insurance company in the process of being paid out. That's the AIR, assumed interest return. The AIR is selected by the policy owner, usually from among 2 or 3 options available to him or her. It might be a 3% AIR or a 5% AIR that the annuitant can choose from. So what's the difference? Well, for one thing, the more money that an insurance company can earn in terms of interest, the higher the payment will be in the distribution. So it would seem to make sense that an annuitant would select an AIR that is the highest amount available. In our example, it would make sense that they choose a 5% AIR versus a 3% AIR because out of the box, the annuitant is going to receive a higher income with a higher AIR. However, there's a danger in doing that, and that is simply this. If, in fact, the variable annuity does not earn enough to support that AIR, then the insurance company is going to adjust future payments to reflect the actual earnings. So, In our example, if the annuitant selected a 5% assumed interest return, and in fact, the annuity only earned 4% growth since the last annuity payment, then the insurance company is going to have to reduce that payment to reflect the actual growth. However, if the annuitant had selected a 3% assumed interest rate and in fact earned 4%, then next month's monthly payment is going to be increased to reflect the fact that actual earnings exceeded the AIR. So the real question that needs to be asked by the annuitant and by you as the annuitant's guide in choosing an option is this: do you want the assurance that future payments will remain level and possibly increase, or are you willing to gamble that future earnings will exceed even the higher AIR and allow payment? Because if a decrease in monthly income is going to be something that's not going to be appreciated by the annuitant, then selecting a lower AIR is the best option.
Okay, did everybody get all that information? Well, if you did, you'll find out in these quizzes here. All the following statements are true regarding a variable annuity are correct except one, which is what? We need to do these live, so if anybody's actually watching this and not ghosting, because I do get views and subscribers, but nobody barely likes or comments. So comment if you would like to see these things in the future, and then you all can help me answer these questions. The value of each annuity payment is directly affected by changes in the AIR. If the value of the annuity unit grows at the same rate, payments to the annuitant will stay the same. One of them is except one. So one of these is wrong. I don't know which one. Okay, whether a variable annuity's monthly income rises, falls, or stays the same depends on what? The number of annuity units, the assumed interest rate selected by the contract. I'm going to go with that one. I don't know if it's correct or not. Which statement about variable annuities is correct? With a variable annuity, annuity payments must increase or decrease. Jenny has purchased a variable annuity. She directs $2,500 of her $5,000 deposit into a contract. How many accumulation units has she bought? I would say 1,500. I'm just guessing. All right, so we got 2 correct, or I got 2 correct. And I totally guessed. How about that? So hopefully we'll do this well on the test. All right, so the one that is wrong here is the value of the annuity grows at the same rate as the AIR. If the value of the annuity grows at the same rate, payments to the annuitant would stay the same. So that is wrong. That's no, that's correct. I'm sorry. That's correct. This is hard to read. The correct answer here, the one that is actually wrong, if I haven't confused you already, if the actual return is greater than the AIR, payments will decrease. The assumed interest rate selected by the contract owner. All right, which statement about variable annuities is correct? With a variable annuity, annuity incomes may increase or decrease based on the investment performance of the sub-accounts supporting them. I actually got that right. Though monthly in payments may decrease, VAs are purchased in the hope that income payments will increase over time. All right, this one is 250 accumulation units of the sub-account because it's 2,500 divided by 10. So she directs 2,500 of her premium, and the value is 10. So that's a little bit of math there. Okay, so that's the end of this lesson. The next lesson is annuity suitability and uses. So if you need help in that area, look for that in the title. I'll see you all in the next video.